Then over to you.
Yeah, absolutely. That seems perfect. And I think for me, it's a very memorable session. I remember from the first year of your annual conference, and this is the 9th year. So at the outset, I'd like to wish you and everybody at Equalify and IAIF all the very best. You guys are doing a great job to enhance our ecosystem of the AIF industry. So thanks a lot for that. So hi, good afternoon, guys. Wish you all a very warm welcome. My name is Anil Ghelani. Aditya, thanks for the very kind introduction. What I'm going to do is over the next not even 12 to 15, maybe 10 to 12 minutes, as Aditya mentioned, I'm just going to give a brief background of what we feel is a very different aspect in terms of investing, and how you as a AIF manager or as an investor or as a potential asset allocator, you can make use of this in the investing world. So friends, I think as we kickstart, I just wanted to highlight, just one very basic and important thing from my side. This is like a standard disclaimer. But then I'll start with some very interesting pictures and a very nice animal. For many of us who are passionate about wildlife or about traveling, you must be very familiar with this. In the north of India, in Assam, this is one of the very popular and very important animal for us as our ecosystem, not just as a species of animal which we are trying to protect. But more than that, this is a very important from our world of finance. Many of you friends might recall this. Various animals and birds get coined in our markets, and with the GFC, global financial crisis, we had a very popular animal, which was the black swan. And just a couple of years after that, Michel Foucault, in a very nice book, had coined this phrase called gray rhino. Well, everybody knows that rhinos are gray in color very often. So what it tries to depict, the gray rhino, is that we often tend to have certain behavioral bias, which miss out the way in which the markets are going to respond to, or any particular large event is going to take place, though it's very upfront in front of us. So friends, today, as we kickstart with the backdrop of how the capital markets and economies world over are, it's a very difficult situation for investors, in terms of how they are going to be able to allocate their funds. So I just wanted to put this at the starting in terms of how it's becoming more and more important for our investors, or for us as asset managers or financial advisors, how to guide our clients in the current environment. We don't know, it's a little bit uncertain how it's going to happen, but overall, yes, there is a very broad direction. The gray rhino is right in front of us, coming charging towards us. We need to be careful and conscious of this. Very interesting book. Later on, if you want to read, anybody, do take a look at it. And then if we look at now what that's leading up to, these are two very interesting monuments. It's like obelisk. One is in the Washington DC, one is in Buenos Aires in South America, in Argentina. I will say, Anil, what are you talking about? Don't really understand. So, well, as an analyst, as a financial markets person, we can just keep it in mind that, when we talk about the Washington consensus, okay, it's about the fiscal and monetary policies by governments and central banks, where Washington consensus versus the Buenos Aires consensus are very two divergent policy making stance. So in Washington consensus, people follow a prudent fiscal policy. They want to ensure that there is a very nice way of doing business, deregulation. It helps globalization, And in Buenos Aires consensus, it's exactly opposite. It is very populist. Kharcha karte raho, expand your fiscal balance sheet. So we need to be very conscious that in the next couple of months, or maybe a year or two, how larger parts of governments are going to move towards. Are we going to move structurally to more of Washington consensus type of a policy making, or Buenos Aires consensus? Because that will be very important in terms of determining how the broader economy and our capital markets will move going forward. So I just wanted to leave this thought with you as we move towards the next part, and connecting that with our world of the alternatives, or why there is a need, or what would be, in my view, the three key points which will drive the need for alternatives. Whether you are, friends, an AIF manager looking into Cat3, like what we do at DSP, maybe doing a long short fund, maybe doing some long only funds in equities, or you are a Cat2, like doing a specialized credit or debt opportunities, or Cat1, Cat2 might be PEVC. Structurally, three key points, which will be drivers: search for alpha, the need for enhanced diversification, and protection against uncertainty. Well, one will say, well, so what? I mean, this is a very clear thing, but yeah, I think these are going to be the key drivers, because overall the way in which the trends are changing and markets are changing, this is the key driver. So now, friends, if you look at history, Indian equities specifically, I have very less exposure or zero experience in PEVC, so I will not speak about that. But if you look at Indian equities and we look at long histories, typically speaking, Indian equities have been more volatile as compared to the counterparts, let's say in US or in the Euro region or in Asia Pacific. So what I feel that such higher volatilities, in fact, provide excellent opportunities to generate alpha or to deliver outperformance through active management of both long as well as short. You can take exposure to your long bets by going positive on companies which you feel are going to do well, and at the same time you can short and make money from your positions which you feel won't do well. And then you can also create options or use F&O for your portfolio. But friends, this all can be done only through AIF platform. So here the need for enhancing the AIF platform, the need why we feel clients will need this kind of allocation, because you can't do this elsewhere. You can't do it in, let's say, for example, a mutual fund or a PMS platform where you can express this kind of views of both long as well as short and buffer it up with some kind of a derivative strategy or use options to either hedge or to amplify your return. Friends, this is a very important thing. Like many clients, let's say if we were talking about just April 2020, many of the clients started seeing that there will be a lot of liquidity sloshing around in risk-free assets. As soon as we see a risk-on environment, we'll see a good upside. And to amplify that upside, you could have bought options in your portfolio not to protect or hedge your downside, but many of them could have purchased call options that, okay, I have your long portfolio and I'll buy call options so that when your return expectation of a bull market plays out, it will amplify your returns, with, of course, a higher downside risk potential, no doubt. So what I mean is that this kind of opportunities will be very unique and it can create opportunities to short as well. Now, friends, you'll say, okay, so in this, where does the way of looking at quant investing or rules-based investing come in? Now, I'll just highlight this in a very interesting way, like what we talk about random walk theory, or what do we think when we are looking at capital markets? Now, today's whatever action is happening in the market, I'm not meaning by today exactly like today, like the date of today, like 10th of February when we have RBI policy, but general, I'm saying, it's not influenced by technically yesterday's price, like somewhat how we roll a dice. Today, what I roll will never impact what outcome is going to happen when you roll the dice. But over time, as we mine data, as we capture data and use it to our strength, then these kind of outcomes like a roll of a dice, you can have a normal distribution curve and then use quantitative methods to harvest the data and use it for your investment strategy. So that's where quantitative research or quant investing comes into the picture, with a combination of where it can benefit portfolio management and constructing good winning investment strategy. Okay, so very quickly, when we look at quant models, you are trying to create certain investment policies or certain investment themes, bundle them as rules, and then take away the human bias out of it. So you create a model, then you let those rules run without a human bias on a day-to-day basis. Don't say, "Ye company result hai, acha RBI policy has declared this. Now what should I do in my portfolio? Should I tweak my allocation?" Maybe leave that for the moment. Wait for your model to run on its own. Focus on those rules to deliver performance in your portfolio. Right? So that is what we look at when we say quantitative research or factor investing. Sometimes many of us might be hearing. So friends, just in a summary, when we look at factors, what are we saying? What does it mean? So very similar to when you are eating some food, and if you have been given a diet by some dietitian that, hey guys, on a day, X quantity of proteins, Y quantity of minerals, Z quantity of carbohydrates, that's how you have to eat. And then you focus on the underlying constituents of your food items. You will forget what item I've eaten. Oh, today I've already had 2 cups of coffee. Now I'm going to have less of coffee, but more of it. You'll say I have X quantity of carbohydrates done. Now I'm going to focus and get my protein from somewhere. Similarly, for securities, each security or each, let's say, for example, asset class can be dissected into its risk and return objectives, which are nothing but what we call as factors. It can be growth, value, momentum, fancy words can be emerged for it. But structurally, I'm just connecting the dots, how this kind of data, large level of inputs and quantitative research can be combined for this. So I'll just take it with one example, how quantitative investing or how such kind of rule-based investing can help you to evaluate good companies across sectors, right? So friends, today, if you're looking at some company, what will you look at? In simple layman term, forget all this fancy stuff. In layman term, like I said, if a dietitian is giving you a diet, what will you say? Okay, I need a diet which will help me remain healthy and fit and help me prepare for the upcoming, let's say, for example, Delhi Marathon or Mumbai Marathon, for example, right? Likewise, I will then focus on X quantity of protein, carbohydrate, minerals, XYZ. Similarly, when I'm looking at a good company, what will I say? I want to buy a good company, of course, with good prospects for growth and at a good price. Fair enough, very simple. So how you can dissect this into quantitative analysis or factors is that you focus on quality as a factor. Then you focus on the next very important factor is the growth, that okay, there is a good quality of the earnings, whether these earnings have a growth potential, and the value factor, that at what valuation are these available, right? So what I mean to say in conclusion is that we can use these kind of quantitative factors to determine certain rules which can be applied to evaluate companies across sectors, okay, and across market cycles. Like we saw in the beginning, there is a big gray rhino rushing towards us. There are a lot of black swans around, which indicate that it's difficult to predict how policymakers, both central governments and central banks, are going to respond and react. Friends, we are coming from a very different timing. Last 18 to 20 months have been a coordinated efforts by both central bank and central governments to ensure that there is a good enough liquidity in the system to support the growth and to avoid the downside of the broader economy slipping down. Now, going forward, how do you avoid human bias? How do you take into account the different risk and return drivers of securities and create this kind of rules which can help you in your portfolio? And as we saw, the AIF platform can be a very interesting platform to use, where you can combine a long and a short and options portfolio to create some kind of a unique strategy for your clients and for your investors. So with that, friends, I had set my alarm for 12 minutes, but I do have about 3 minutes left. In case there is any engaging discussion, any questions, any feedback, comments, Aditya, I'm shutting down my screen, and I would be very happy to have any discussion or any questions.
Sure, Anil. Just audience, if you have any questions, quickly please use the tab Ask a Question and please put up the questions.
And while the question comes up on the tab, just one very interesting thing, as I said, Aditya, like I'll just go back into history. Sometime during 2007, I was doing a paper trading using only quantitative analysis, and we were paper trading a hedge fund, which could have some long and some short. At that point of time in Indian markets, we could not implement that strategy because this current AIF regulation, which we see today, was not in place at that point of time. So we were trying to do the paper trading of that and launch it in some global platform through our erstwhile JV partner who had a global platform in Cayman Islands or in some other jurisdiction. But subsequently, now in India, we have a very unique this platform of AIF regulations, which can enable this kind of strategies to be run very easily and very successfully. So I wanted to bring this up in today's discussion to all our friends and community in the AIF industry and in the wealth industry, that today, there are many such long short funds already available, different strategies being used. Some use quantitative strategies, some use a combination of fundamental and quantitative. I feel a combination is always much more powerful. The power of decision making of something and some other thing is always much more powerful. And I feel it can be a very good driver, and AIF platform can be used very effectively by managers who are working on quant strategies, managers who are working on algo trading or quant-based strategies for that. Great. So if there are any questions, happy to discuss, or any views, happy to review. Otherwise, we can take it offline, guys. I'm sure Aditya will share any of my LinkedIn or Twitter feeds.
One question has come in, Anil. Can we quickly take?
Yeah, I can hear you. Yeah, Aditya, please. Yeah.
Hello.
Yeah, I can hear you, boss. Please go ahead. Yeah.
Yeah. So, what have been some of your mistakes while pursuing your investment approach? Lessons learned.
Very good point. Very good point. And I'll connect it with this thing which I was talking about during 2006-07 period, when we were using quant-based investing to run a portfolio of long and short in Indian equities. Wherever you are using quantitative investing, this is just one of the mistakes. To be very honest, there are many mistakes, especially in the world of investing. you do keep making mistakes, and important how you can learn from it. So at that point of time, one mistake which I would like to share with everybody to always keep in mind, whenever you are using, let's say, certain factors in India or in many emerging markets, momentum as a factor often is considered very powerful, right? Or trend following. Friends, I would like to also recommend a very interesting book over here by Michael Cowell. It's called Trend Followers. Very interesting book, very nice. I have got a lot of learnings from that. Do take a time to read it. So what happened is that we were using momentum as a quant filter to identify, let's say, 10 to 15 stocks where we would go long, and about 10 to 15 stocks which we would short. Shorting was done only through derivatives. We used to short the futures contract. There was no SLB market very vibrant at that point of time where we could borrow stocks and sell it. So we would use derivative. So some component of the portfolio would be kept aside as a margin for the taking position in the F&O. 10 to 15 stocks, maybe 20 stocks at max would be long, and similar number would be short. Now, what happened over there is that at that point of time, we were in a good momentum cycle, and suddenly GFC, Global Financial Crisis of 2008, hit. So what happened is that there was a sudden change in the drivers of the companies which were doing very well. Quality as a factor suddenly took a very huge turn. Momentum stocks, suddenly there was a change in the market segment and the way in which the market was driving. So what happened is that our portfolio takes time as a momentum portfolio at such inflection points. So suddenly all the stocks where we were long were starting to underperform significantly. And all the stocks which, based on our quantitative method of momentum as a factor, we were short, suddenly now started performing well. And it was like a huge cycle of reversion to mean. So we were bleeding on our shorts and our longs were underperforming. Now, what happened is that by the time some changes and some thinking could be done and a model could be revised, okay, we came to 2009 where due to the quantitative easing which had started by US and then followed by European region and many other regions in Asia Pacific, it had started turning the tide and all companies were starting to rise again. So again, there was an inflection point in the market. So whenever you are using a single factor, it's always very much risky if you come across such inflection points in the market. So you need to be constantly aware and tracking these global top-down macro trends whenever you are investing in such kind of strategies. So friends, again, as I'm saying, just to circle back, this is just one learning. One can have many, many learnings, but in summary, this is a learning that one needs to be well diversified, even if you are using a quant-based, rule-based strategy. If you are using only one factor, try to diversify and incorporate maybe 2 at least or 3 factors. Like this model I showed you, it is actually a similar type of thing which is actually being run in one particular strategy where 3 factors are being used: quality, growth, and value. So if there is an inflection point, some other factor will help in buffering up that part. So I would like to leave everyone with that one interesting learning from my side.